Welcome back to Investing Talk podcast. We know you're looking for that critical knowledge to make informed decisions. And today, well, we're tackling one of the really complex stocks in the aerospace sector, Boeing. The big question on everyone's mind is pretty simple, isn't it? Is Boeing a good buy right now? Before we really unpack this company, if you find this analysis helpful, please do remember to subscribe, like, and maybe comment below. And also, hey, if there's a specific company you want us to look into next, just leave us a comment. We really do love tackling your requests. Okay, so let's get into this operational puzzle. Boeing's been all over the headlines, hasn't it? Swinging like violently between these massive, generational order books and then kind of tripping over its own feet with some troubling operational hiccups. We've gathered the latest fundamental, technical, and catalyst data we could find right up to September 2025.
What's really fascinating here, I think, it's just the sheer tension in all the sources. It's what we're kind of calling the operational paradox. I mean, you've got one half of this critical global duopoly, right? Unparalleled demand strength. But then that strength is constantly undermined by execution risk and, well, a highly leveraged balance sheet that, frankly, looked like it belongs to a much smaller, maybe struggling company.
Okay, so let's start with some positives then. The upside from the last quarter, say July through September 2025, that revenue report back in July, that was a massive surprise, wasn't it? Where did that optimism come from?
Oh, it's stellar. Yeah. Revenues hit $22.75 billion. That's a substantial jump, 34.9% year over year. And this really confirms one half of that paradox we mentioned. The world desperately needs planes. The underlying global demand for aerospace products, it's incredibly strong.
Yeah.
So the result was, upgraded full-year revenue outlooks pretty much across the board.
Okay, but here's where it gets really interesting for you, the investor listening in. Even with that, blistering revenue growth, the market kind of just shrugged. The stock actually lagged the S&P 500 in August. It dropped, 8.7% month over month. So why the disconnect there?
Well, the market's laser-focused on execution, not just promises. Those strong revenue numbers, they came alongside whispers, right? Whispers of ongoing manufacturing challenges. Specifically, disruptions in the 737X assembly line. It's sort of a classic case of not being able to deliver on the capacity you have. And the slow pace, it keeps damaging the reputation, and it resulted in analyst downgrades.
Right, and one of those downgrades you mentioned was partly based on that Zach's value style score of F. Now, for the listener who maybe hasn't been deep in the data lately, what does a low value score like F really signal about market expectations for future growth, especially when, revenue was strong?
Yeah, it's a good question. It basically signals that the stock is trading at a premium valuation relative to its current financial health and, its historical performance compared to its peers. So in essence, the market loves the idea of Boeing, right? They know its competitive position, but the operational reality suggests, well, maybe it's overpriced for the risks it carries right now.
Okay. Before we dig into the full financial picture, September brought this forward-looking strategic move, the Palantir partnership. Why Palantir specifically? Why are they betting on them for the defense segment? What does that tell us about the competitive pressure they must be feeling?
Well, it's a pretty clear signal, I think. They realized they needed a technological leap to compete effectively with the other defense giants. That September 23rd announcement, it's aimed squarely at accelerating AI adoption across their defense and space segments. And the expectation is this will drive growth in those, high-margin classified government programs.
Yeah.
And also modernize their entire tech stack, which is pretty critical for the long-term health of that defense unit.
All right, let's look under the hood then at the 2024 financials. Let's try to understand the company's structural health. We've established the demand is there, no doubt. But can they actually afford to manage this current operational chaos?
Yeah, the financials, they tell a pretty sobering story. It goes straight to the heart of that paradox again.
Yeah.
Total revenue hit $77.79 billion in fiscal year 2024. That's a solid increase from the prior year, definitely. However, they still reported a net loss of $2.24 billion. Now, while that loss is an improvement over the previous year's, nearly $5 billion loss, the continued inability to turn that global demand into sustainable profit, that's the core issue facing management.
A $2.24 billion loss, even improved, that still seems staggering given the demand we keep talking about. How much of that is really systemic inefficiency versus just, these abnormal costs from the 737 MAX saga?
Well, I think a significant portion is systemic inefficiency,
Sure.
kind of masked by these one-time charges. I mean, look at the gross margin for 2024. It was, a meager 7.5%?
Only 7.5. Wow.
Yeah, that margin is just perpetually weighed down. abnormal costs from the 737 MX issues, persistent supply chain chaos, some one-time defense charges. This inability to manage costs effectively means the operational friction is just, well, it's bleeding them dry. It really restricts how much cash flow they can possibly generate.
And if we connect that structural inefficiency to the bigger picture, financial health, the leverage is high. We have to talk about that debt load.
Extremely high. Yeah. We're talking total debt of about $52.3 billion. Net debt sitting around $40.1 billion.
It's hard to even wrap your head around a $52 billion debt load. I mean, that's more than the GDP of some smaller countries. And yet, this industrial giant is, well, indispensable. So what does this mountain of debt actually mean for their future innovation? Or just their ability to invest in R&D and actually fix these production problems?
That's the critical consequence, right?
Yeah.
High debt severely limits their operational flexibility. It just does.
Yeah.
And it impacts their liquidity profile, too. Now, their current ratio, it's 1.23, which looks okay on the surface. That's typical.
Yeah.
But the quick ratio, that's very weak, 0.35.
Right. And just to be clear for everyone listening, that weak quick ratio, it means they don't have enough easily convertible assets like cash or things close to cash to cover their short-term bills easily. That's a classic signal of a lack of financial agility, isn't it? It forces them to always be reacting instead of, say, proactively investing in quality control.
Exactly. And maybe even more alarming is the negative interest coverage. It was negative 3.1 times in FY 2024.
Negative.
Negative, yeah. And this raises a really important question. Why is this number so bad? It means the company isn't even generating enough operating profit to cover the interest payments on all that debt. It just highlights massive structural inefficiency. And it puts them, frankly, materially weaker than competitors like Airbus on that front.
But wait, they have that massive backlog, right? That's always the thing they tout as their impenetrable competitive moat.
Yeah.
But is a massive backlog actually a positive right now? Or could it be turning into a mounting liability given these issues?
That's the really counterintuitive question, isn't it? It defines the paradox. Yes, they possess a massive backlog. It covers multiple years of production, and that confirms their indispensable duopoly position, no doubt. But that competitive moat, it's increasingly viewed as narrow by a lot of analysts, precisely because of these execution risks. I mean, if production keeps stuttering, those long-dated contracts, they start turning into sources of potential penalty fees and reputational decline, rather than just guaranteed profit down the line.
So it sounds like the competitive scale is definitely there, but the operational issues are actively preventing them from capitalizing on it. And that's allowing Airbus to gain a majority market share in single-aisle jets.
Precisely. They retain the scale, absolutely. But the execution risk is truly constraining their potential.
Okay, it really sounds like the fundamentals are, well, a bit of a mess, plagued by financial strain, operational friction. But sometimes the chart, it ignores the balance sheet, at least for a while. So what's the market feeling right now? What are the technical signals telling us?
Yeah, the charts are giving us whiplash, frankly. They suggest pretty high uncertainty. As of late September 2025, the stock's trading around $215.10. That's near the high end of its annual range. So that tells us investors are still willing to pay something of a premium for that underlying demand, despite all the setbacks.
But how does that premium pricing square with the short-term weakness we just talked about? The stock lagging in August, for example.
Well, it creates this really contradictory technical picture. The long-term trend, it appears to be improving. The price is above the 200-day simple moving average, which is around $193.45. But the short-term trend, that shows clear weakness. It's trading below the 50-day simple moving average of about $227.25.
So if we look at just the trading signals, it's almost a total contradiction. But we do have a very interesting relative strength index reading here. That might be the market screaming about a temporary value opportunity.
Yes, exactly. The 14-day RSI is down at 21.8. It's deeply into oversold territory. And this deep oversold reading, it's kind of the market telling us, look, I hate the execution problems, but I know the long-term value is probably there, and the price is being forced lower than maybe it should be right now.
Yeah.
So, yeah, it often signals that a near-term bounce might be due.
But you have to consider this alongside the elevated volatility, right?
Yeah.
3.37% for such a large cap industrial stock. That's quite high. So that high volatility shows investor uncertainty is definitely elevated. And the general market sentiment seems neutral, maybe slightly negative, reflected by that fear rating on the Fear and Greed Index, which is sitting at 39. So you've got technical potential kind of fighting against that fundamental reality.
That's a good way to put it.
Okay, now let's look ahead. What are the immediate drivers we need to watch, say, in the next 3 months? Things that could either, ignite this stock or sink it further.
Well, The immediate hurdle, no question, is the Q3 earnings release. That's coming up on October 24th, 2025. And this report, it isn't just about revenue this time. It'll be critical to see if the company can finally show some stabilization in production and get a handle on those abnormal costs we discussed. If they disappoint on efficiency again, well, the stock will likely punish them instantly.
And then right after that, just a few days later, we have market structure events that could move the price, sort of regardless of specific company news.
Precisely. October 28th brings the ETF rebalancing for aerospace indexes, and that can drive significant short-term price discovery and liquidity swings, just something to be aware of. Further out, we'll definitely watch the holiday travel demand report in mid-November. And critically, the disclosure of institutional trades, those 13F filings, later in November.
Right. And for our listener, just a reminder, the 13 of filings are essentially a mandated look into what the so-called smart money is doing. If major institutions are seen buying up large positions in Boeing, well, that could reinforce positive sentiment quite dramatically. It would confirm institutional belief in a longer-term turnaround.
That's absolutely right. And beyond that known schedule, there are several, let's say, aggressive rumors circulating that could become major catalysts if any of them actually materialize.
Okay, let's talk about maybe the most intriguing one. The possibility of spinning off the defense segment. Could simplifying the business model like that really unlock shareholder value, given all the complexity we've been discussing?
It's a massive value unlock hypothesis, and a lot of analysts support it, actually. See, the defense unit, it's generally stable, it's high margin, but it often gets masked by the volatility in the commercial division. So a spinoff, the thinking goes, would give the defense business its own clean, pure play valuation. It could potentially allow investors to price the commercial side purely on its duopoly potential, unburdened by classified contract accounting and all those operational headlines. It would be a major structural change for sure.
Interesting. And other potential catalysts. You mentioned a possible large 737, a max order from a major U.S. carrier.
Yes, that rumor keeps popping up. Also, projections that the dividend might be reinstated maybe by 2026. And those persistent rumors of some kind of international partnership, maybe with Saudi Aerospace, potentially focused on advanced air mobility or something similar.
Okay, so those are all potential positive speculative drivers.
They are speculative, though.
Yeah.
And we absolutely have to balance them against the significant risk factors we've highlighted throughout this whole conversation, because these are the anchors really holding the stock down right now.
Okay, let's summarize those primary risks one last time then, really focusing on what you, the listener, need to track going forward.
Right. The most significant risks are, frankly, entirely specific to the company itself. First, ongoing operational execution problems. This isn't just one program, it's across multiple key commercial programs. Second, the highly leveraged balance sheet. Just remember that $52.3 billion in debt and the negative interest coverage. That's a big one. Third, the lingering reputational damage from all the historical safety issues. That directly constrains their ability to gain market share back from Airbus. And then on a macro level, of course, it faces high cyclical exposure to global GDP. And defense contracts are always subject to those unpredictable political and budgetary shifts.
So after all that, what does this all mean for you? We've covered impressive revenue growth, yes, powered by this unparalleled demand, but also staggering debt and just crushing operational friction. That operational paradox really in action.
Yeah, our sources pretty much conclude that this stock has rebounded significantly post-pandemic. But those twin weights, the operational failures and the high leverage, they severely hamper it. The overall assessment, kind of balancing everything, lands right around a 5 out of 10 rating.
Okay, a 5 out of 10, that suggests pretty balanced risk-reward on the surface. But what's the appropriate investment approach here then? Is it a buy, a hold, avoid?
Well, the investment thesis coming out of the analysis is pretty explicitly defined as high risk, maybe event-driven swing trading in the short term. Capitalizing on volatility swings, perhaps like the current oversold RSI reading we saw. Now, while there is definite long-term upside potential, it's a big if. If those manufacturing bottlenecks are definitively solved, it is not recommended for conservative long-term investment, not until those structural, operational, and financial risks really ease up.
That's a crucial perspective for you to consider. It sounds like the company's next phase hinges entirely on their ability to execute, especially on that October earnings momentum, and successfully secure those defense tech partnerships, like the one with Palantir.
Exactly. And maybe something for you to mull over as we wrap up. Despite all the near-term volatility and those clear fundamental weaknesses we talked about, the very fact that this company operates in a commercial duopoly, It means the demand will fundamentally always be there. It acts as a massive floor, you could argue. So the ultimate question really becomes, how much longer can these operational failures prevent them from fully capitalizing on that truly unparalleled market structure and, finally reaching their true earning potential?
A great question to leave our listeners with. Thank you for joining us for this analysis today. We really hope this knowledge helps you stay well informed.